part 3, knowing your strategy. Now look, I gotta give you a disclaimer. I am not a financial advisor. I am just a random guy on YouTube. Everything that I'm gonna talk about and everything that I'm gonna show you here are for example purposes only. I am not telling you what to invest in. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But when you talk about now your investing strategy, what you have to understand is what is your goal? Do you wanna see growth with your money? Do you wanna see cash flow from your money? Do you want to protect your money because you're worried about something? Your goal is going to dictate what you do with your money. So let me go over a few examples of what this means, and then I'll go over specific examples of how you can actually invest your money into this thing. If you were to go out and invest in growth, what that means is now you're going to invest in something that you think is going to go up in value. You want to buy a stock for $100 because you think it's going to go up to $500. That's what growth means. Cash flow means you want to invest in this thing because it's going to pay you money for owning this thing without having to sell it. So you buy this thing for $100 and it's going to pay you, I don't know, $4 a year, a 4% return, but you're getting this every year without you having to sell this investment. And the goal is to buy something that's going to increase how much it pays you year after year after year. That way now you can build an income that you don't have to sell your investment to get. Now, the pro with this is you get to make money without having to sell it. The con with this is when you make money, you got to pay taxes. Here, if this goes up from $100 to $200 to $300 and you don't sell, that's growth that you don't have to pay taxes on until you actually sell. And the second thing you want to understand here from a more of a theoretical perspective is if this is a company that has this money to pay out, well, if they're giving this money away in the form of a dividend, that's what this is called. A dividend is a cash payment that a company gives you every 3 months, every quarter for doing nothing except owning that stock. If a company is just giving away this dividend, that means that's money that they're not using to open more stores. That's money that they're not using to hire more employees. That's money that they're not using to grow their brand, to invest in research and development. Whether that's a good or bad thing depends on you. It's good for you as an investor because you get your money. But that also means that theoretically, they're not going to be able to grow as fast because there's less money going into growth. So the companies that are paying out this type of cash flow are generally going to be a little bit more mature and a little bit larger, and they have these big cash profits that they don't know how to invest back into the company, so they're just going to give it away. That's how cash flow works. Protection is now, well, I'm not too worried about the growth of the cash flow. I'm more concerned about the United States economy. So I want to move my money somewhere else, maybe outside the United States, maybe into physical gold, maybe into some other sort of asset where I'm less worried about the growth. I just want to be able to preserve my wealth. Once you start to think about what is your goal as an investor, that's when you can start looking for specific investment ideas. Let's stick with the stock market for the purposes of this video. If you wanted to invest in the stock market, there's a couple of different things that you can do. The first thing is, well, if I want to invest in some company that I think is going to continue growing over time, I could try to find the next Amazon, I could try to find the next Apple, I could try to find the next Tesla. But the problem with that is many times when people go out and try to find a good stock to invest in, they don't know how to analyze the company. They don't really know what they're investing in. They understand the company from a public-facing persona, maybe because you've shopped there, you've seen people talk about this, but you don't actually understand the financials. You don't understand the actual company itself. And so now you buy this company, and then what ends up happening for so many people is the stock starts to go down, you panic, you sell, and you really don't know why you always lose money when you invest your money into these companies. If you can relate to what I'm talking about, you're not alone. And this is where investing in individual companies is great for some people, but for the majority of people, there's an alternative, which is to invest in a fund, whether that's an ETF, which is called an exchange traded fund, an index fund, or a mutual fund, which gives you exposure to a broader basket of companies. Now, instead of investing in one company, you can invest in a group of companies. So let's talk about now, assuming you want to invest in more value types of companies. You want to invest in just the stock market in general. You want to invest in the United States economy because, well, if the stock market goes up, you make money. You just want a simple way to invest your money into the markets without having to find the best company. There are ways to do that. For example, there is an ETF out there called VTI. If you go out into the stock market and you buy one share of this fund, VTI, you're buying a piece of the total stock market. This is a fund created by a company called Vanguard. Vanguard is an institution that creates these types of funds. And if you buy one share of VTI, you're buying a little piece of every company that trades on the United States stock market. It's a simple and easy way for you to invest in the total stock market without having to find the perfect company. Another example is SPY. This is an ETF that gives you exposure to the S&P 500. The S&P 500 is a group of the 500 largest companies on the stock market. This is an ETF created by the company Spider, SPDR, again, an institution that creates these types of funds. And so now, if you just wanted to invest in the larger companies, you can invest into SPY, and now you're getting exposure to the 500 largest companies in the stock market. Now, the nice thing about this is if you invest into this fund, and one of the companies goes bankrupt, well, your whole investment doesn't go bankrupt. The fund will then kick that company out and put another company in. That way, it's more passive on your end, and you're just exposing yourself to the United States stock market, but more particularly the 500 largest companies in the stock market. How about another example? DIA is an ETF that gives you exposure to the Dow Jones. The Dow Jones is one of the longest and most well-known indexes in the stock market. An index is a group of companies. The Dow Jones is a group of 30 large, well-known, generally blue chip companies. Blue chip means large, established, and well-known companies. And so now if you just want to invest in the Dow Jones, you can invest in that through an ETF like DIA. Again, this is created by Spider, SPDR, an institution that creates these types of ETFs. This way now, instead of trying to go out and find the perfect company, you can just invest in the fund. But let's go a little bit deeper. Let's say for the purposes of this example that you want to create cash flow, you want to create a new income stream that you don't have to worry about all the time. Are there funds that can give you exposure to that type of cash flow? Yes, I'm going to go over a few examples. NOBL, VYM, SCHD. By the way, the reason why these have asterisks next to them is because I personally have money invested into them myself. Starting with Noble, NOBL. This is an ETF that gives you exposure to dividend aristocrats that are in the S&P 500. This is going to get a little bit technical, but let me explain what this means. Number one, this is investing in dividend-paying companies that are in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Out of these 500 companies, some of them are going to pay dividends, some of them are not. This is investing in the dividend-paying companies. But it gets a little bit more sophisticated because it doesn't just invest in every dividend-paying company in the S&P 500, it invests in the dividend aristocrats in the S&P 500. A dividend aristocrat is a company that has been paying and increased their dividend every year for the last 25 years at least. So this is investing in companies that have paid out and increased their dividend every year for at least the last 25 years that are also one of the 500 largest companies in the stock market. That's what this ETF gives you exposure to. Then you have VYM. This is another ETF created by Vanguard, which is a high dividend yielding ETF. If you want to invest in broader companies that are paying out the higher yield dividends, this is an ETF that gives you exposure to that. A similar type competitor to that is SCHD. This is an ETF created by Charles Schwab. Again, focus on investing in dividend-paying companies inside of the United States. So if you're looking to invest in companies inside of the United States that are paying out dividends, here are a few examples to start your research. Not telling you what to invest in, giving you examples. But let's go a little bit deeper now. What if you want to invest in companies outside of the United States? Is that possible? Again, I have a few examples for you here. By the way, if you're looking for an easy way to stay up to date on what is happening in the markets, when it's happening, I created a free resource called Market Briefs. It's a free newsletter that my team writes every day, which breaks down what's happening in things like the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. I promise you are going to love Market Briefs. And if you say, well, Jaspreet, how can you promise that? Well, if you don't love it, you can unsubscribe at any time because it's completely free. So if you want to join Market Briefs, I got the link for you to join down in the description below, where you can go to briefs.co/market. Now, when we talk about international companies, here are a few examples. MCHI, this is an ETF that will give you exposure to Chinese companies. INDA, you want to guess where that gives you exposure to? You got it. This will give you exposure to Indian companies. EEM is an ETF that will give you exposure to emerging market companies. This obviously has a little bit more risk, but more potential upside. And this is where now you want to think about what is your strategy? What is your goal? For me, and I don't recommend what I do to anybody else, my goal is cash flow. That is the bulk of my investments. When I invest in real estate, which is the #1 largest passive investment that I have, real estate is for cash flow purposes. When I invest in the stock market, the bulk of my passive investing are for cash flow purposes. Now, I do invest in some stocks, not for cash flow. I do invest in startups, not for cash flow. I invest in a number of places, not for cash flow as well, but the majority of my investments are for cash flow purposes because that's what I like, that's what I understand, because if I put my money into this thing, it will then pay me for owning this thing and I don't have to sell my investments to get paid. I like that. So for me, cash flow is something that I like to invest in, but you need to know what is your goal. If your goal is growth, if your goal is value, if you want to get exposure to emerging markets or to international companies, once you know what your goal is, then you can build a strategy. Just understand that if you're investing into these types of funds, the way that you build wealth is not by investing your money one time or two times. It's by building a passive investment system where every week, or every 2 weeks, or every month at least, you're investing your money into these things, and you do that whether the market's up, whether the market's down, and you set it and forget it. That was an automatic investment system. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.